In my previous video, I highlighted 3 index funds that I think will be great long-term investments, but it's important to have an understanding of what an index fund is. So I'm going to run through what an index fund is, why you need index funds in your portfolio, and the GOAT of all index funds. So the first ever index fund was created by this guy named John Bogle. Bogle? Shout out Bogle. In 1975. He realized that a fund holding the exact same securities in the exact same proportionate weightings as a broad market US index would guarantee the exact same return the economy generated. If you are confused by this statement and why it holds true, we need to first analyze what an index is. So an index, in layman's terms, is just a representation of something. In the case of the stock market, indices are used to gauge general sentiments of a certain sector or the economy as a whole. One of the most utilized indices is the Dow Jones Industrial Average, or the Dow. You might have heard of this before. The Dow measures the performance of the 30 largest companies in the US, generating a single number that more or less gives an indication of the overall health of the US economy. For instance, if the economy is performing well, people are shopping, buying things, the 30 largest US companies will typically perform well, which by definition means that the Dow performs well and the resulting number increases. Vice versa if the economy is not doing well. Some say a more accurate reflection of the US economy is another famous index called the S&P 500. Instead of measuring just the 30 largest companies in the US, the S&P measures the performance of, hence its name, 500 large US companies. This gives an overall better indication of the economy as a whole and is much less subject to volatility. This guy, Bogle, realized that if he made a fund which held securities from these exact 500 companies in the exact weightings as they exhibit within the S&P, he could essentially match the exact return generated by the US economy. This would be called an index fund, as it is a fund seeking to track or mimic a specific index. A classic analogy of purchasing a single security is to put all of your eggs into one basket. An index fund would be distributing your eggs into many baskets. Although I don't understand why and who is throwing around baskets of eggs, why one can't just suffice, just don't trip. Bogle made a company with a 6 sailboat logo and named it Vanguard, which still today is the dominant index fund distributor. The first index he designed, coined the Vanguard 500 Index Fund, still exists today. There are slight derivatives of this fund under ticker symbols VFV on the Toronto Stock Exchange and VOO on the New York Stock Exchange. I discussed and broke down both in detail in my previous video, so if you haven't seen that, go and check them out. These are staples to any well-diversified portfolio. Although past performance has little to no indication of future performance, looking back at the US economy, it's hard to bet against its steadfast power. Many investors state that allocating literally 100% of your portfolio to broad market equities in the form of an index fund is the only way you can guarantee to match market returns, and this typically beats investors picking and choosing individual stocks. Index funds are a risk-adverse way of generating a stable positive return on investment, and after the power of compounding, can generate wealth that grows long-term at an exponential rate. By definition, 50% of liquidation in the stock market outperforms general market returns, while 50% underperforms general market returns. Keep in mind, when you're allotting your money into stocks in the market, you're essentially getting into the ring against investor powerhouses like Warren Buffett, George Soros, Peter Lynch. Those are literally the 3 investors I know. So will they out-invest you and tip the scales into you underperforming general market returns? Probably. Buying into broad market index funds, although less enticing than the potential of striking gold in individual securities, ensures that you will remain on par with the US economy. Not holding broad market index funds such as VFV and VOO is essentially betting against the power of the US economy, which is not a bet I would take.